a beautiful pattern. Similarly, let's say if you're doing some kind of exercise and you are plotting that data over time, you will see your oxygen level, blood, it actually fluctuates. So based on the pattern which is getting created, we can actually understand or analyze this data so that it will help us to predict things in future, right? Now here I have actually given two examples. These are also time series data. So one is ECG record, which is basically the pulse rate, which is getting measured. And on the right-hand side, you have the stock returns. Now here you can see in the two scenarios, the ECG, it's actually getting measured in a seconds interval, right? And the stock return here you're actually measuring over years. So you can have the time interval at various levels. It can be at seconds, minute, hours, day, weeks, months, or even years, or even more than that, maybe 10 years, right? So there is a very famous data for time series analysis, which is known as air passenger data. So that data actually covers, I think, around 50 to 60 years of information, okay? Mostly a decade wise of information. And you can see over 10 years period, how the air passenger volume is changing over time, right? So this is the basics of time series. So now we will move on. So time series is actually pretty important. Why? Because not only it's helping us to do some prediction, but it's also helping us to know when this number will be applicable. So let's say I'm saying that the sales number for a particular industry will be 1 million, let's say 1 million units. But I also want to understand when this 1 million will be hit, right? Whether it is next month or 2 months down the line or 1 quarter down the line or 1 year down the line. So timely prediction is very important, right? And it is actually needed for any industry, be it for any kind of sales industry, or let's say if we are into some hotel business, how many customers are checking in or will check in the future, or let's say if it is in the aviation business. In aviation business, we want to know how many flights are scheduled, to take off in a particular time zone, or let's say how many customers are going to book for that particular flight, so that this kind of information we can feed in to the system, and that will also help us to do dynamic pricing. Okay, so the price. So you will see when you are going to measure the or book something in the online portal, the prices change. That's because it actually tracks how many people are actually trying to book that particular flight from a futuristic standpoint, right? So based on that, it actually impacts the dynamic pricing logic. So all these things, this time series analysis, it's actually applicable for any industry, okay? Whether it is pharmaceutical or let's say in finance, we use time series heavily. So in every domains, in every scenario, in every organization, we are actually using time series. Okay. So now let's understand the various components of time series at a very high level. I'll try to explain. So I have given here two charts. One is on the left-hand side, we can see we have the sunspot numbers over time, and on the right-hand side, we see a sales data. Now, this sales data is basically it's hypothetical. I mean, it's not a realistic data from any company. It's a hypothetical scenario. But the sunspot data, it's real. Okay. Now, if you look at the sunspot data on the left-hand side, you will see.
Hello.
Hello.
Sir, can you duplicate your slide show? Yeah, we are seeing the slide preview view. So at the top, you can just check display setting. You can just give it a. At the top, you are seeing display setting, right? So taskbar display setting at the top.
Okay.
Yeah, display setting. Can you click the display setting?
Sure. Where is it? We can't see that here.
Can we minimize this? I think we will.
Yeah, how?
Yeah, we can see display setting.
Okay.
Yeah.
Du- Duplicate?
Slide. Yeah, duplicate slide.
Okay.
Is it better?
Is it all good now?
Yeah, it's fine now. Yeah. Okay.
Thank you. Thank you. Yeah. So as I was explaining, so on the left-hand side, we see the sunspot data. Now, if you look into the sunspot data, you will see that a beautiful pattern is getting created over time. And so we can see some kind of a sine wave pattern getting created over time, although all the peaks may not be at the same height. And also on the right-hand side, if you see, we see a similar kind of pattern. We see some kind of seasonal pattern getting created, and along with that, the data it's actually increasing with time. Okay. Now from these two charts, what we are trying to understand is the components of a time series. So on the left hand side, what we see, this is known as a seasonal pattern. Seasonal pattern is something which repeats over time. Okay. So let's say if I am a ice cream vendor, okay, I sell ice cream, let's say. You will see that the ice cream sales, it peaks during this summer, okay, and then in the winter time the ice cream sales drops down, okay, and this happens at.
Sorry for interrupting. Can you tilt down your camera a little bit down? Only yeah.
Fine now?
Little bit tilt down.
Yeah. Okay. Okay. Cool.
It's better now.
Okay. Yeah. So as I was saying, so you have so let's say if you look at the ice cream sales pattern, you will see that in every summer of a year, you will see the ice cream sales, it spikes up, and then in the winter time it drops down, and this pattern gets repeated over time, over the years, right? So what does this mean is in time series data, there is some kind of a repetition which happens over time, and that repetition is known as seasonality. And this kind of pattern we have to analyze so that we can extrapolate this pattern in future, and that will actually help our forecasting whatever things we are trying to forecast in future. Similarly, on the right hand side, what we see along with, so here also we see some kind of a seasonal pattern. So you see of for every year in Q3 there is a spike, right? And the overall data, that is also increasing with time. So along with seasonality, there is something which is known as trend. Trend is basically the growth of the data, growth or decline of the data over time. So here what we see, the data is growing over time. That, let's say if this is sales data, what we can understand is the overall sales, it is actually increasing with, I'm sorry, it's actually increasing with time. So this overall growth of the data or overall, let's say, decline of the data, is actually known as trend from a time series standpoint. So these two are very important components of time series, which we try to analyze so that we can, predict the future better. So we separately analyze time seasonality, we separately analyze trend, and finally we combine this together and we try to forecast the future. If we are doing time series forecasting, obviously, in time series, we can do many other things. So we will deep dive into this component in the next slide. So here we see various kind of components of time series. I talked about trend. I talked about seasonal variation. So trend is basically the growth or decline of the data over time. Okay. So mostly you will see from a very, if you take the data, cross section of data for a quite long time, maybe a couple of years, you will see overall the data is showing a persistent movement in one direction. Okay, either it is growing or it is declining, and and that is known as trend of the data. Okay, let's say the GDP of a country. Okay, the GDP of a country, you will see if it's growing with time. Let's say for India, okay, you will see that data is growing with time. Obviously, there will be some fluctuations here and there, but overall, you will see it's actually moving in one direction. So that's what we understand by trend. Now, normally trend is linear. Okay, that means you can actually fit a straight line. Like here, you can see, we have tried to fit a straight line for all the points which we have plotted. But there can be other kind of trends as well, like exponential trend, quadratic trend. Like let's say there is a sudden spike in the data. Okay, so that time what happens? Linear trend, you cannot fit a linear line there. You have to understand like what kind of curve fitting is most appropriate for that. Now, another thing is linear trend can be a good proxy for exponential or quadratic trend as well. Why? Because what you can do is you can actually have small linear trend over time, and you can fit those small linear trend one after the other, and that can actually replicate a exponential trend or a quadratic trend as well. Okay, that is something we call as piecewise linear trend fitting, which some of the models in time series or methodologies in time series can take care of. Because otherwise, it will be very difficult for us to understand uh, what kind of curve we are going to fit as for the trend, right? So you have to try out multiple trend modeling for exponential, quadratic, or cubic. There can be many trend line which you can try out, and that becomes very difficult. Rather than that, it's easy to fit linear trend, and based on the gradient of the trend, basically you have to see like how much the trend is increasing with time. That is the gradient of trend. You can actually fit small linear trend which will actually mimic any kind of curve, right? Sometimes you don't have trend. It's like a flat data, and that is what we call as level, which we see in the first curve, first diagram. So it's a flat kind of trend. That means actually we don't have any trend. So here what is happening, there is no pattern as such, and the value is kind of a constant, like a straight line. You can feed a straight line where the slope is 0 over time. So that means we don't have any trend, and that we call that as a level. And then we have seasonal variation, which I have already discussed. It's basically a repetition after a fixed cycle. It can be hourly, daily, weekly, monthly, quarterly, etc. And there can be multiple reasons for which we have seasonality, right? One I mentioned is, it can be natural. Let's say, when it's during summertime, the ice cream sales spike up, right? Similarly, during the monsoon, the umbrella sales spikes up. So these are natural. Sometimes it can be man-made. Let's say, there is some economic recession happening, okay? And there is a fall in the GDP, okay? And maybe it is happening every 2 years or every 1 year. So that is something which is man-made. Okay. So now these are the things like level, trend, seasonal variation, and all. This is something which we can model. We can analyze the data. I think maybe some of you have gone through this course called signal processing. So basically, you can consider time series as a signal, and you can process it. And after processing it, you can do a lot of decomposition of the time series, and you will get all these components like level, trend, seasonality, and all. But even after we have separated out all these components of time series, there is something which is known as the error term, which is the random error, which we cannot model. There is always a part which is a noise which we cannot model using a time series, right? Or any kind of statistical model, whatever we see in data science. There is always a part which is unpredictable. Now that unpredictability is known as this error term or random fluctuations. Uh, Now, there are many ways, which I'm not going into the details of that, but there are many ways by which we can understand whether the error terms which we have at the end, it's actually the true error, or still we are left with something that we can extract from that error term. Okay. So ultimately, the thing is, this is something which we cannot model, and specifically for this reason, there will be always scenarios where we won't be able to predict something with 100% confidence. I cannot give you a forecast, let's say 3 months down the line, and say that the number which I'm giving you, it's 100% accurate. There will always be some deviation from the actual. If it is 100% accurate, then it is by fluke. Maybe, luckily it coincided. But normally what happens, there will always be some error or, random noise in the data, in the forecasted data. So moving on. So another component in time series is known as the cyclical component. So this is something which is, we have already discussed about seasonality. Cyclical component is similar to seasonality, but this is on a long-term basis. And sometimes it doesn't repeat also. So the cyclical component is something which we cannot model. Let's say during COVID time, we saw all the industry, suffered, the sales dropped and everything, right? So it lasted for, a couple of months, almost like 1.5 year, I'll say, right? That is a cyclical effect. And we don't know whether this thing, this kind of, pandemic and all will again occur in future or not, right? So sometimes it can repeat itself, but we don't know the period. So that's why we don't consider cyclical component in time series analysis as such. Moving on. So now we will discuss from a very high level, what is the time series forecasting methodology. So we start, it's actually pretty similar to all the data science models which we develop, like let's say regression or classification model. We start with data pre-processing, data cleaning. We create, we check for outliers. Now there is now when we say outliers means, let's say we see some sudden spike in the data, right? In time series. Now, maybe from data science standpoint, we think this is outlier, but actually that is a valid point. So whenever we are actually working or treating outliers, we always have to ensure that, we discuss things with business, like whether this is a legitimate outlier or this is actually a, true data, which we have to use for our analysis. Okay, this can be a signal. Sometimes you will see that during Black Friday sale, the sales spike up suddenly in those 3 days, right? Now, if you look at the overall data and compare the Black Friday sales, it will look a kind of outlier to you, but that is not an outlier, right? It's actually a legitimate data. So always, we have to ensure, like whatever treatment we are doing, we have to, get a confirmation from the business, like, and then only we can take it forward. Now, after that, we have to define some testing strategy. So when we say testing strategy, it's basically known as back testing. So whatever techniques or methodology you are using, whatever is your hypothesis, you have to test it out over time, historically. Let's say in the last 12 months, whether it is working fine or not. And after that, you have to select or develop the models. You will do the HPO and parameter tuning. And if it is a univariate analysis or whether it is a multivariate analysis, you have to select your features accordingly and models also accordingly. And finally, you will validate your model and identify the best model, which you will take for deployment. Yeah. Here I have given two scenarios for testing, which is known as sliding window concept and expanding window concept. So normally in data science, you may have seen that we test our models by doing cross validations, right? Now in time series, cross validation is a little tricky because you cannot shuffle the data. That will actually break the sequence, right? So what do I mean by breaking the sequence? Let's say time series data and text data is very similar. Let's say I comment a statement, I work at Cargill, okay? Now, each of the word, it's associated with a timestamp. right? I comes first, then I said work at Cargill, right? But if I jumble up everything, Cargill work at, it doesn't make any sense, right? So the timestamp of the data is very important. Similarly, for time series data, the timestamp of the data is very important. We cannot jumble up things. So we time series is like a forward-looking analysis, and we have to create our testing strategy accordingly. So it actually depends like what kind of data you have and what kind of business logic you're trying to solve. So accordingly you select your testing strategy, and yeah. So finally, once you evaluate and identify the best model, we discuss with the business, and then we can go ahead for implementation. So this is a pictorial diagram, which basically says how we can do the time series forecasting at a very high level. So let's say you have a daily data, you clean it, you can do some adjustment. If let's say for a holiday adjustment, let's say the ask is to get a weekly forecast. So you aggregate the data at a weekly level, you check for seasonality and all. Then you have multiple models, or it can be the same model with multiple settings or multiple parameters value, right? Uh, Now, after that, you select the best model, you do the back testing and all, and you finally you have finalized which model you are going to use. You get the data, aggregate the data, and again there is a section for post processing. In post processing, here I haven't mentioned everything, but in post processing you can actually do a lot of things. There can be many rule-based techniques also which you can use. And finally, you go for the daily forecast, and then you can generate the weekly forecast. These are some of the time series models which I've highlighted. Here I have tried to classify the models into two areas. One is the classical models, more equation-based or statistical models. And on the left-hand side, on the right-hand side, we have more recent models, which are machine learning or deep learning based. Okay. So the basic models is moving average, then you have exponential smoothing, various forms of exponential smoothing, then you have ARIMA class of model and the volatility models, which are arch and Karch. And here on the right-hand side, you have various kind of deep learning based model and tree based models as well. Now, it depends how much data you have. It depends what is the business ask. It depends what kind of analysis you're doing. Based on that, you have to do the model selection. Model selection, there is no thumb rule. It actually depends on you and the business case. And based on that, you can select the right model for your analysis. Moving on to the next section. So we understood a little bit about time series, various components of time series. Now the question is why why time series is important. I mean, why do we need to learn time series? Because in data science you have so many regression algorithms and all. Why time series is coming into picture, right? So here, I mean, in time series, the thing is, if you are able to predict the future accurately, that will actually impact the profitability by a big margin. Okay. So we will see why I say so. Maybe we will take one use case here. And yeah, just give me 1 second. Yeah. So this is one use case which we are, from Cargill only. So what we are trying to do here is we are trying to predict the future of some products for a particular market. And the reason is this will actually help the business to accurately produce those products. And if we are able to accurately produce those products, it will actually make the process more lean and profitable. Now, why it is so? The reason is if we have a lean system, then we are actually generating what is needed. We are not generating something extra, right? That means we are able to satisfy our customer whatever they need at the right point of time. So let's say in January, the customer needs some X amount of products, okay? And we know accurately before time that these are the items we have to manufacture over time, right? That will actually improve our customer experience. That is first point. Second point is, if we don't overproduce anything, we are using the right resources. That means we will have less carbon footprint, around us. So it will actually help us to, be more lean over time. And finally, as I mentioned earlier also, the profitability, it will be impacted by a big margin. The reason is, if we are not producing anything or under producing anything, we are producing things at the right amount. We don't have to pile up things as inventory in the warehouse, right? So because if you produce more, you have to put things in the warehouse and you have to, give a cost for that as well. So that is very, that actually eats up majority of the profit from your P&L. So, so this is one use case which we have recently worked on. This is on a very high level. We cannot disclose the details, whatever we have done here. So basically, as I mentioned earlier, we do post-processing, pre-processing, we do the modeling, and then we do post-processing as well. And finally, once we have the numbers, we actually have to understand how accurate we are from a futuristic standpoint. So once we have the actuals, we measure our forecast versus the actual, and we try to understand how accurate we are, right? So this is one use case which we worked on recently. Now, apart from forecasting, there are other use cases for time series as well. So first is determining the patterns. So let's say we are doing some kind of a transaction. Let's consider a financial system. Let's say multiple customers are doing transaction, and suddenly what happened during night time, you see that the number of transaction has increased suddenly for a particular section. Okay, now that is an unusual pattern, right? I mean, normally, if you look overall in historically, you will see that at night times, normally the transaction should be low. Now, if suddenly during night time, the transaction volume is increasing, and it's actually happening from a different location, so that is actually a different pattern, and you can actually trigger some kind of alarm that this is an anomaly in the whole process. Okay. So that time series actually helps you with anomaly detection when you have large amount of data. Obviously, time series is mostly used for forecasting for the future data. And apart from that, another use case for time series is, let's say, from a retail standpoint, you have many products which you have under your bucket. Okay, let's consider Amazon. Amazon has so many products which they are selling. And if Amazon wants to forecast something for all the products, let's say, like what will be the demand of these products maybe in the next 6 months, it's very difficult to do that, right? You have, let's say, 1 million products under Amazon or maybe more. So how can you do forecasting for so many products? So then what we have to do is we have to understand like which time series are similar, and is there a possibility that we can group them together? So for that also, you have to understand how similar the time series is. Some kind of a correlation you have to find between time series so that you can group them together based on seasonality, or let's say various kind of other factors are there. And once you have grouped the time series together, you can actually take that group and you can build a model which can forecast for that entire group for the future. Okay. So that is basically you can do this by understanding the patterns and clubbing them together. So overall, these are the broad areas where we see time series application. Now, here are some of the use cases which I mean would like to call out. I mean, these are some high level use cases, but each and every industry around us is actually using time series analysis. It's so critical. Um, I'll start with retail and manufacturing. So in retail and manufacturing, as you understand, demand forecasting is very important. We need to understand the demand of the products from a futuristic standpoint. uh, price forecasting. So we want to understand the what should be the price of the products which we are trying to procure. It's actually important for a manufacturing company. So manufacturing company, they have to procure the raw materials, right? Uh, Now the raw materials price, if we can predict beforehand what will be the raw material price of product A 6 months down the line, that will actually help us to price the final product which we are manufacturing, right? Let's say we are manufacturing a car. And now there are a lot of components which we need as raw materials to manufacture a car. So if we can scope or forecast the raw material prices, from a futuristic standpoint, that will actually help us to price the car accordingly. We should be at par. We should not be overpriced, or we should not be underpriced. Otherwise, what will happen? The competitors will have an advantage there, right? From finance standpoint, let's say we want to understand the volatility of the stock prices, right? Now, stock prices, is something which you cannot predict. Stock price prediction is very, very difficult. I mean, someone who can do stock price prediction, I think he or she will be the next billionaire. But yeah, stock price prediction is not possible. But stock price volatility measure, or how volatile the stock price will be in future, that is something which we can predict. So predicting stock price pattern is something which we can do from a time series analysis for the financial domain, right? Then, for agriculture business, time series is very important. Through time series, we can use time series in weather forecasting. It will actually help the farmers, the companies like Cargill, who makes contracts with the farmers. Uh, and we will be in a better position to price the contracts, right? What should be the right deal price when we are, going to the farmers to make the deals, right? And like for Cargill, we also do B2B business, right? So the end contract, that can also have a big impact if we are able to, use the time series forecast and we are accurate with the time series forecast. In healthcare also, we have a huge, use of time series. We can use this whenever we have any pandemic. We can actually analyze the data and we can understand how fast the disease is, going to uh, transmit between the people. Of course, for disease transmission, we have other models also, but time series can also be a good, candidate here. So going forward, yeah, so that's pretty much about it. And I have also highlighted about anomaly detection, the use of anomaly detection in time series. This is basically for the fraud area, like how much fraud is happening in cybersecurity, in predictive maintenance. We can use time series. Uh, Price prediction for dynamic pricing. Customers who are using the app, they will actually have a better experience if we can infuse the time series information along with the normal pricing analysis, right? Then yeah, so that's on a high level the time series use cases. Then we have like, let's say if you want to start about on time series forecasting, like these are some of the resources through which you can start. And these are some of the models, basic models actually, with which you can start the analysis. The reasons I have highlighted these models compared to the machine learning or deep learning model is sometimes for time series, accuracy is not the main concern. As I mentioned, accuracy can be high by fluke. Maybe, it's a coincidence that your forecast and the actual numbers are very close. uh, what we need to understand is why the model is able to predict this. Okay, so the models are they explainable to business? So in case the model is doing good, why the model is doing good, or if the model is doing bad, why it is doing bad? Because when the model is doing good, everyone is happy, right? But if it is bad, everyone will question you, like because you developed the model, and at that time, if you can't explain why the model is doing bad, then the model is actually of no use, right? So we also have to understand about something called model explainability. And simple models are, it's easier to explain. They have been designed in that way. Obviously, I mean, I'm not saying that, we should not go for complicated models. Obviously, we have to go for complicated models, but it also depends on how much data you have. Okay, because as you understand in machine learning or deep learning, you need more data. With less data, it becomes very difficult for you to do prediction. The models will be overfitted, right? During training time, you will see that the model is doing a great job, but maybe when you have the actual data, the forecast will be horrible, right? So this is basically something we call as bias versus variance. Here I have also highlighted two other models, which is known as Arch and Garch model. Maybe I'll just cover it quickly. So Arch and Garch model are known as volatility model. These are mostly used in finance domain, uh, which I explained earlier. Like, let's say you have stock prices and you want to understand the volatility of stock price from a futuristic standpoint. So there, what happens? You actually try to predict the volatility. You don't want to predict the actual number there as such. Okay, so in that scenario, like how volatile the stock price will be standing today for the future, these can be addressed by this kind of models. In normal scenario, we don't use Arch or Garch model. Okay, we mostly try to do point estimation using the other models which I have highlighted earlier. That will actually help you to do point estimation. Another thing in time series is, along with point estimation, we also have to specify the bounds. What do I mean by bounds? Sometimes point estimate is too much, I mean, sometimes point estimate can have high fluctuations. The reason is time, I mean, as you're predicting for the future, you don't know what will happen in the future, right? Let's say you're standing in 2019 and you are forecasting for 2020. And in 2020, the COVID happened. Everything dropped. You don't know anything. You don't know beforehand COVID will happen, right? So how will you tackle those situations? So for that only, we have this bounds. What we say is, uh, although we are giving you a point estimate, but to be on the safer side, the data can be, I mean, the actual forecast will be within the bounds. Like this is the upper bound of the forecast and this is the lower bound of the forecast. It should not go beyond the bound. And how you define the bound, that is actually defined by something known as confidence interval. Okay, so let's say if I am like 90% confident, then the bounds will have some value. But if I want to increase my confidence to 95%, then obviously I have to increase my bounds, right? Naturally. I mean, if I have a higher bound, it's more likely that the actuals will be within the bounds, right? So yeah, that's on a very high level, how we do time series modeling. And obviously the model selection techniques and all, it's very much dependent on the particular use case you're solving. You may have to do a lot of pre-processing. You may have to club multiple models. You may have to do a lot of post-processing as well. Some deterministic rule you have to infuse. And there is no thumb rule for that. So that's why, time series is not very straightforward. It's slightly tricky. Uh, Another advantage, which I forgot to mention earlier, about time series is uh, sometimes, I mean, the reason why we use time series over, normal prediction is sometimes you only have the historical data, and that's it. You don't have any other features, right? So for normal, regression models and all, you have features, right? With the features, you try to predict something. But here, let's say you don't have anything. You only have that sales data, and you want to predict sales data only, and you only have the sales data. What to do, right? So that is one of the reason why we use time series when you have very less information. And also at the same time, there are a lot of checks which we have to do before starting a time series analysis. Whether the data which we have, it is feasible for us to start a time series model or not. It can happen although we have a time series data, but the data is not fit for time series. There are a lot of statistical checks which we have to do, perform to understand whether the data which we have is fit for time series or not. So yeah, so that with that, I'll stop here and I'll start with the Q&A. So yeah,
Something in the chat.
how do you check that?
Mhm.
So any question, any queries?
Excuse me, sir, can I ask a question?
Yes, please.
Okay. Sir, a bit background. So I am doing this data science course from IIT Madras, and apart from that, I am a startup founder. I operate from Bangalore. So basically, my company makes software for the textile industry of India, the MSMEs who have big revenues as, let's say, 200 crores or something like that a year. So these people so far have been doing everything in an offline way. So imagine a company of such scale without a IT team, and this is where we come in. We provide them IT support. So many of our clients, our customer now wants to somehow do the export work apart from the domestic work which they do right now. And also they want us some prediction model to be done from the point of view of how their customer would behave, or let's say what are the type of item they could produce or should focus on in next quarter or something like that, what garments should they buy, etc. So what do you think that how can what model or what way should I approach towards solving this problem with the help of data science? Like, I mean, if you get me.
So, so basically, what you're asking is you run a business, right? And you want to. So I didn't get the last question. So, what are you trying to predict?
Basically about the garment which the manufacturer should focus on, because there is a repetition, right, after a certain cycle. For example, this season, certain design might work better, or certain quality of garment, let's say cotton clothes or a polyester or something like that. And also, if they want to focus on export in the near future, then how data science can help in that way, if possible.
So first of all, let's say you have a couple of products which you mentioned. First, you need to understand which are the products you have to focus to, right? Basically, maybe you are producing multiple products, but let's say some of them are more profitable. Okay. So which products you want to produce? Maybe I'll say the more profitable products, right? You can focus on. Now, how much you have to produce, when you have to produce, for that you have to, do some exploratory data analysis, which we call as EDA. So EDA will basically tell you like whether there is any kind of pattern in the data and all. What kind of model you need to use that for that. We have to deep dive and sit with the data and understand. But a basic, EDA will actually tell you a lot of things, like which are the top products, what is the pattern in the data, and how, how you should focus on, and what are the products you actually need to produce more based on a profitability standard.
Hello, am I
Hello.
audible to you, sir?
Yes.
Sir, I am Urusha Rahat from Student Placement Council. So in this session, I can help you with the question asked in the chat section. So we have 2 to 3 questions. Divya, can you unmute yourself, or do you have any question?
ಅವ್ನು ಒಬ್ನೇ ಯಾವತ್ತೂ ಹೋಗ್ಲಿಲ್ಲ. ಅವನು ಬಿಟ್ರು ಕೂಡ ಅವ್ನು ಬರಲ್ಲ. ಅವ್ನಿಗೆ ಸ್ವಲ್ಪ ಭಯ ಇದೆ. ಇನ್ನೇನು ಒಬ್ನೇ ಬರ್ತಾನೆ. ನಾವು ಬ್ಯಾಕಲ್ಲಿ ಇರ್ಬೇಕು.
Divya, can you unmute yourself, please?
ಹೌದಾ ಅವನು ಅಲ್ಲಿ ಮೇಲೆ ಇರ್ತಾನ ನೋಡಕ್ಕೆ
I will request to co-host, please unmute Divya.
ಮೇಲೆ ಹಾಕೊಂಡು
So moving forward, sir, in chat session, we have a question from Mahesh. He is asking which function shall we use for performance measure? I repeat, which function shall we use for performance measure? It is a
Right.
question from Mahesh, and with this question he asked, RMSE is good to predict error accurately or not?
Yeah. So, which function? So there are a lot of functions actually. Yeah. Now, RMSE is a good measure. Yeah, obviously.
Okay.
But RMSE you cannot explain to business, right? Because business basically understand from a percentage standpoint. So you have the actuals, you have the forecast, you divide it by the actuals and convert it to a percentage. RMSE you cannot compare. So that is one problem with RMSE.
Okay.
But obviously, if you are trying to select a model, you can do it by looking at the RMSE. Sometimes even RMSE is not fit. Sometimes what happens, so these are some classic examples. Let's say when you forecast, you have the actuals. You will either under forecast or over forecast, right? These are the two scenarios. There are very, very less possibility that you will be just on the point, right? You will do a accurately exact forecast. It will be either under forecasting or over forecasting. So sometimes what you have to do is, based on the business demand, you have to penalize under forecasting. You want your model not to do under forecasting much. Over forecasting is okay to some extent. Obviously, then it's not that you can forecast, like if it is 500, you predict, forecast 1,000. That is not possible. You over forecast up to a limit. So you have to penalize under forecasting as well. So there we have a lot of weighted factors, which we used in this, error calculation. We have weighted RMSE, we have weighted SMAP, all of these are there. So there is a classic example in Kaggle, which is known as M5. You can look into this. It's known as M5 forecasting challenge. So there the ask is you have to penalize or weight the forecasting based on under forecasting and over forecasting. So yeah, it depends, like, from business to business. So RMSE, it's not explainable to business. Okay. RMSE is good for you to understand like which model is doing better. Let's say one model will have X as RMSE, another model will have, let's say, Y. You compare between X and Y and you can take a call. From a business, they always prefer APE, which is absolute error percentage. You can weight that with some factor, weighted APE. And you can also do this over forecasting and under forecasting scenario, weight them accordingly, and you will get business will get a clear picture there. Yeah, does that answer the question?
Yeah, thank you so much for the detailed answer. We have another question from Kirti. She's asking how digital signal process is used in time series analysis.
Right. Yeah, digital signal processing is pretty interesting. I think in digital signal processing, you must have learned about Fourier transform and all, right? So Fourier transform is heavily used here, So basically in time series, there is something called decomposition. So what I explained earlier, so you have a time series, you have various components, right? You have trend, seasonality. How we arrive at this? We have to decompose this, right? So there is something called Fourier transformation. I think you guys have worked, studied Fourier transformation. So yeah, so that is the relation. There are other ways also, by which you can decompose, some heuristic methodology and all. But Fourier transform is something which we use. It's actually inside the model only. I mean, you don't have to write as Fourier transform and all those thing, but you need to understand how Fourier transform works. Yeah.
Yeah,
Does
totally
that
understand, sir. Yeah.
Okay. Thanks.
So moving forward to the next question, this question is from Sai, and he is asking, what skills would you recommend for a student to learn apart from ARC and GARCH? I hope I pronounce it correctly. Looking to enter the finance industry in the field of stock trading.
Yeah. So stock trading is something which I explained earlier. If you can accurately predict the stock price, you will be the next billionaire. Okay. So there is a lot of analysis, going on in stock market. I am not an expert in stock market actually. So Arch and Garch, yeah, it gives you the volatility measure. But apart from that, you actually have to factor in a lot of other, criteria. Let's say market sentiment is there, news feed, live real-time news feed, a stocks technical analysis. You have many components when you analyze the stock: RSI, MACD, moving average, Bollinger Band. So all this information needs to be there. Okay, you need to look at the fundamental analysis of a stock. So when you are creating, let's say, if you're only focusing on a kind of a predictive model, these will be your features. So these features will flow in technical features, technical analysis feature, fundamental analysis feature, news feeds, market sentiments, companies, P&L, profit and loss statement, and everything will flow in. That will give you a robust model. Okay. It's very difficult to pull all these things, right? You have to scrap so many websites, news articles. And if you're able to get all this information in one place on a real-time basis, yeah, because let's say you have this information on D-1, then it's of no use, right? So the stock price would have gone to somewhere else. So if you can get all this information at the right time, then obviously you can use this in stock trading.
Thank you so much, sir, for the answer. And we have another question from Ananya. She is asking for some resources to suggest for beginners to learn more about supply chain analytics.
Okay, so supply chain analytics, I think there are a lot of courses available online. There are, so I actually passed out from, IIM Mumbai, which is known as NITI, which used to known as which was NITI earlier. That is there they offer actually multiple courses for supply chain. So if you want to do an offline course, by giving CAT and all. So yeah, but if you want to do a online course, in YouTube, you have many courses available free of cost. If you want to do some certification courses, I think in Udemy or Coursera also you will get multiple supply chain analytics courses. In supply chain analytics, you mostly have to study OR, and along with that, you have data science as well, like time series, predictive analytics. Nowadays, in new age supply chain analytics, you also have machine vision, computer vision, robotics, and all, through which you can do automated farming, agriculture. Selecting the right crop and all those stuff. So those can be done through computer vision and robotics. Yeah, so this is on a high level. I think, in YouTube, you will get a lot of supply chain courses by NPTEL or maybe from MIT or Stanford also. I think there are some free courses available in YouTube as well. Yeah.
So another question is from Nimisha. She is asking that how will you predict uncertain things such as sales, earthquake, waves, weather report, and especially for which the future is completely tough to predict. So what should be the strategy?
We cannot predict those, right? Those are nature's those are at nature's will, right? Um, Earthquake prediction, I think till now there is no mechanism by which we can predict earthquake. Otherwise, we could have saved multiple lives. Similarly for tsunami and all. Whether we are to some extent we can predict with all the satellite and all we can predict the weather data to some extent, and weather data actually we use for time series as well, like whether there will be rainfall or not, how much precipitation will happen, and let's say how much heat wave will flow. Those things we can predict to some extent. We use those information for accurate price analytics or demand forecasting.
So we have another question from Yug Dubey. He's asking, please explain how these models are made.
That is a that is a very for that we have to have separate sessions, right? I mean, where I can explain how these models work and all. So that I cannot answer in one line. Each model has their own techniques, own hypothesis and all, right? And the models has been made not overnight. I mean, there has been a lot of thoughts, a lot of experiments, and a lot of thinking and all. So one thing is, I will take one last question. After that, we have to,
Yes, sir.
Yeah. So yeah.
Sure. So this is our last question. Ananya is asking, in the talk previously, you have mentioned that while explaining about selecting models, accuracy is not important in time series. Can you elaborate a bit more on this?
Accuracy is not important. I mean, accuracy is important actually. Okay, if your model is not giving you good result, then no one will use it. But what I'm saying is, let's say you have a model which is giving you 95% accuracy, and another model is giving you, let's say, 85% accuracy. But the 85% accuracy model is robust. What do I mean by robust? It means for the next 6 months, it is giving you 85% only. Okay, there is not much of fluctuation. Yeah, there can be some little bit of fluctuation, but the 95% model, in 1 month it is 95, next month it is 65, 1 month it is 75. Okay, so there is too much volatility in the prediction, too much fluctuation. And second is the 95% model, accuracy model, you are not able to explain to business like why this volatility is happening, why there is so much fluctuation in the data. Whereas in the simple model, which is giving you 85% accuracy, there you actually can explain like why this issue is happening, why this volatility, why there is sudden drop in accuracy. Okay, so that's what I mean by why sometimes accuracy is not a concern. If you're able to explain to the business, or if that is a data issue, then all the models are okay. But we actually have to be pretty much okay with the forecast which we are generating. It should be stable. It should not fluctuate like this. Otherwise, business will not use it, right? So that's what I mean by, sometimes accuracy is not important. Accuracy is important, but, not at the cost of, if we can't explain the volatility or how the forecast is working. Okay, so let's say I'll give one example. Let's say if you have a deep learning model where you're trying to predict based on images whether this is a cat or dog, right? But sometimes what can happen is the model can make mistake. It can say that this is a dog when the image is of a cat. Now, if you can explain why the model is making this mistake, then all right, then you're able to explain, which is known as explainable AI. Something similar for time series as well. Like you need to understand why the model is making mistake, right? Yeah.
So as we approach to the end of our session, I want to express my sincere gratitude to you, sir. It was really wonderful for sharing your knowledge and expertise with us today. And I would also like to extend our appreciation to Cargill Business Services for hosting this event. And thank you all for being a part of this enriching session. Thank you.
Thank you. Take care. Bye.
Bye, sir.